What if I told you that the entire global economy, yeah, every stock market, every big corporation, every little coffee shop down the street, runs on an idea that's over 500 years old? It's true. Today, we're going to break down the elegant, basically unbreakable system that quietly powers everything: double-entry bookkeeping.
To really get why this is so important, we have to rewind the clock a lot. Imagine you're a merchant back in Renaissance Europe. Business is good, your ships are coming in, goods are flying off the shelves, and you've got a purse full of coins.
But here's the million-dollar question, or, the million-florin question. Are you actually making money? It sounds simple, but back then, it was a surprisingly tough question to answer. Without a solid system, you just didn't know. You were basically flying blind.
The early methods they used, this stuff called single-entry bookkeeping, were, to put it lightly, a total mess. They were described as loose and defective for a reason. You couldn't even check if your math was right. You never really knew where you stood financially, and it was ridiculously easy for mistakes, or even outright fraud, to go completely unnoticed.
But then, out of all that financial chaos, came a breakthrough, a whole new way of thinking that would finally bring some order to the madness. And it's all thanks to one guy.
So in 1494, this Italian mathematician, Luca Pacioli, who we now call the father of accounting, published a book that literally changed the world of business forever. Now, he didn't exactly invent the system from scratch, but he was the first person to write it all down and explain it clearly, laying the groundwork for, well, all modern accounting.
And the effect was immediate. See, this was about so much more than just recording numbers better. It was about creating clarity. And even more important, it was about building trust. For the very first time, business partners had a shared, reliable language they could both use to see exactly what was going on financially.
So what was this revolutionary idea? What was the secret sauce? Well, it all boils down to a simple, elegant, and perfectly balanced equation that is behind every single transaction. The absolute best way to picture this is to think of an old-fashioned balancing scale. Every single thing that happens in a business financially has two sides. And for the books to be right, that scale has to stay perfectly, and I mean always, level.
And this right here is the fundamental accounting equation. Assets, that's all the stuff a business owns, like cash or equipment, must equal the sum of its liabilities, which is what it owes to other people, like banks, and its equity, which is what it owes to its owners.
The logic here is just so clean. It's almost like a law of physics for a business. Everything you have, every single asset, has to be claimed by someone. It's either claimed by an outsider, a creditor, or it's claimed by an insider, an owner. The claims must always equal the stuff you own.
Okay, so how is this perfect balance maintained day to day? Well, it's all done using two little words that can seem really confusing at first, but are actually super simple: debit and credit.
All right, I need you to forget everything you think you know about these words from your bank statement. In the world of accounting, debit just means the left side of an account, and credit just means the right side. That's it. They're just directions, telling you where to put the numbers to keep that scale perfectly balanced.
And here's a fantastic little trick to help remember how it all works. Dead click. The stuff on the left side of that big equation, expenses, assets, and drawings, those accounts are increased with a debit. And the stuff on the right side, liabilities, income, and capital, those are increased with a credit. Simple as that.
These ideas are often boiled down into what are called the three golden rules of accounting. For example, for your real accounts, which are basically your assets, you debit what comes into the business and you credit what goes out. For your nominal accounts, that's your income and expenses, you debit all your expenses and you credit all your income. It's a clear, logical framework for everything.
Let's see this in action, okay? Let's say your business buys a new computer for $1,000, and you pay cash. So you debit the computer account for $1,000 because an asset, the computer, is coming in. At the same time, you credit the cash account for $1,000 because another asset, the cash, is going out. See? One side goes up, one asset goes down, and that scale stays perfectly level.
This right here, this is the magic of double entry. Every single transaction is like a mini self-correcting event. It has two parts, a debit and a credit, and they must always equal each other. That's the system's superpower.
So why? Why has the system from the 1400s not just survived, but become the absolute universal standard for all of modern commerce?
I mean, the sheer staying power is just astounding.
While our technology has completely changed how we do the work, the core principles, debit on the left, credit on the right, have been the same for over 500 years. They've outlasted empires, currencies, and countless tech revolutions.
It's simple, really. It works. That two-sided nature makes it self-checking. If your debits and credits don't match up, you know instantly that something's wrong. It makes it way harder to hide fraud, it creates a transparent financial picture, and at the end of the day, it builds trust. The kind of trust that is the absolute bedrock of our entire global economy. It's what allows for big investments and the rise of modern capitalism itself.
So you see, double-entry bookkeeping is so much more than just a technical chore. It's a language. It tells the story of a business's health, its history, its integrity. It is a 500-year-old system of trust, written in debits and credits. So the only real question left is, what story are your numbers telling?